when should we be worried about earnings comps or the upcoming expected change in quadrants?
Well, you should worry when the market starts to get worried, right? I mean, earnings comps, you could have been worried this whole time, which we told you not to. We said to understand that that is going to be coming. So once we get into earnings season, we will see if it matters. Of course, that's in April, so it's March. So we're getting closer to April because that's what comes. March comes before April. So we're there. We're there. You know the catalyst. You ask the question properly. You could ask it every day. Again, it might start to matter today. Imagine the Nasdaq stops making all-time highs. So again, this is essentially the point. Going back to essentially, what are we trying to do here? Let the market tell you. Let the market tell you when those catalysts matter. At the same time, work really, really hard at understanding what those catalysts could be so that you're prepared for them and not surprised when they start to happen.
Yeah, no, I think that's a great point. If you go to, I want to say slide 39, we show our GDP forecast for the balance of the year. And it doesn't look pretty in terms of rate of change terms in the back half of the year. But again, we don't want to be front running that. We want to allow the market to sort of lead us to that outcome in terms of when it might start to price it in, or you start to see some changes in style factor leadership and sector leadership.
Yeah, wouldn't that be completely not ironic if this dot right here, see that? Mm-hmm. If the Nasdaq peaked in Q1 when GDP peaked, wouldn't that be ironic? Not. Okay. No. So again, you're isolating the most growthy component of major global equity market indexes. Mm-hmm. So that asset allocation, by the way, we're not making that same call on Germany or on France or on, I mean, if we were, we would be long those equity markets. So again, it could be pricing it right on time. I mean, I love it when the market prices things in concurrently because it makes it easier. When a market starts to front run you by 3 to 6 months, what the economic data is going to look like 3 to 6 months from now, that's harder. Okay, and I think we saw the preview to the movie, of course. But again, what happened in that preview was that people got too hocked up about inflation, and that, of course, our call was that would roll over. So some people turned around and said, okay, that's going to be perfect. The market's going to love that. I didn't disagree with that. Neither did the market, evidently.
Yeah, totally. And then lastly, we're just getting a question on our headline GDP forecast. So that 261 translates into 1.68% year over year. We are the low on the street, and really for the first time in 5 quarters. That compares now to the Atlanta Fed, which is up at 248, 2.48, coming all the way down from 5.5.
Oh my God.
I mean, completely useless. And then Bloomberg consensus at 265.
So where that'll matter, it could matter literally the day before. Mm-hmm. It's where the market is when you come into a catalyst.
Totally.
Think about it like the weather, okay? You park your car in the same spot all the time. But what happens if you parked it there on the day that we had all that snow in Connecticut last week and all those branches started to get really heavy? Well, all of a sudden now you could have a branch right through the top of your car, okay? Because you parked it there during those prevailing conditions. So it's not about the car always having been there. It's about the conditional factors, in our case, growth and inflation, changing and expectations changing. Mm-hmm. And then all of a sudden, boom, you know the weather's coming that day. You didn't have to park your car there. You could have put it in the garage, or you could have driven it to Florida. I don't care what you did with your car. But if you put it underneath a gigantic old tree, you know that there was risks associated with that. Okay, so this is the whole point. CPI tomorrow really matters now that the bond market has done what it's done and positioning's done what it's done. So these catalysts, as opposed to getting hung up, like a lot of our new subscribers, we blow their mind because we have these accurate forecasts on growth and inflation, but their minds are blown because anytime we say anything negative, they're like, oh my God, I gotta get sell, because they've been trained to do that by these damn people on TV and on the internet. That's not how you do this. You have to time things, okay? The 2 dirtiest words for newsletter writers, particularly those that are selling you, basically giving you stuff for free, newsletters, is timing matters. Do you think John Malden can time markets? No, of course. I would never ask John Malden to time markets. I would absolutely ask him to organize a conference that I could go and learn a bunch of stuff at. That's what he's good at. He's not going to tell you when to time markets or when to move your car. I'll ask the weatherman for that. So again, these things really matter. They all matter. We look at all of it. And God willing, we're going to be accurate on those things, but we're also going to have at least the humility to let the market help us time when it actually matters.